Down 1%, Alphabet 1%, Meta 2%, Apple 2%, and Amazon is down 4%. That's fallout from FedEx. We just got the latest read on the consumer sentiment. That's an important indicator at this point in time. The number?
59.5. So it fell. We were expecting it to rise to 60. So it's at 59.5. It's a fresh number. It's September. How consumers feel about the economy, how inflation impacts them, and the Fed watches that number, as we know.
Yeah, not a good number by any means.
Yeah, so 59.5. I'm not sure if it rose or fell, but it was a disappointment.
That's the read. That's the number. Okay, yeah. I've not seen any immediate impact on the stock market. You're still down, still plenty of red ink. I want to bring in David Strzelecki, who joins me now, market watcher of this Friday morning. David, here's what worries me, that the market goes down and stays down for a long time, a bit like the 1970s. Do you see anything like that coming?
Well, Stu, I think that some of the most important indicators that we've all known and have followed for the last decades are actually telling us some of those things. So as an example, the Shiller PE ratio, which looks at the last 10 years, that is elevated at 48% above the average. That's an overvalued position. If we look at the Buffett indicator, an indicator of GDP and total value of the stock market, that says that we're overvalued by 47% right now. So if we see those numbers and we understand what they mean, I mean, Shiller's data specifically gives us, better than 120 years worth of information that we can look at. And that would say that based upon the elevated levels that we're at today, we're either going to be slightly negative to zero over the next 10 years. So people might be buckling up right now for this next bear market in expectations that we're going to have another lost decade.
Well, if it's like that with stocks, I mean, if that's what happens, you're just dead flat to slightly negative for 10 years, where'd you put your money?
Well, that's a great question, Stuart. So at our firm, we've adopted a strategy that we call CPR. What we're doing is looking at evaluating where are we putting our cash, our protected assets, and our risk. And so we need cash, we need protected assets, we need risk assets. I can't time when the market's going to be up or down. No one knows. Anyone who says that they do, guess what? They're going to be dead wrong as well as they're going to be absolutely right. So what we try to do is approach this from a balanced answer. And so I love what you've been saying. Hey, I've got some short-term treasuries. That's going to be more like a cash position.
Yeah.
Smart today.
Yeah.
Want to be able to redeploy when things do go back on sale. But we need to be evaluating our protected assets today. And so bonds are not the answer. And we need to be more specific in our stock allocations right now, as we just need to look at our peers.
We've talked about this before. I'm looking at the one-year Treasury yield today at 4.06%. I mean, that's astonishing to me. If I buy it and I hold it for 1 year, I get a guaranteed 4%, I get a tax break, and I get safety. I mean, I just don't see what's wrong with that, David.
Well, there's nothing wrong with that, but we're seeing recessions here. We're seeing a global recession right now. I think that places like cash are very important. These types of global recessions are very rare when they occur. And so we've got this significantly inverted yield curve, which is what you're talking about. That's also an indicator that we're going to have some challenges here in the market going forward. But yeah, getting paid is good. The only negative is if we've got inflation, let's just say at 9%, and we're getting 4%. We lose at 5%, guaranteed.
But he who loses least wins. That's my opinion.
Bingo.
Bingo. I like that. David Strzelecki, thanks, sir. We'll see you again soon. Thanks a lot.